Mr. Volcker, if I can sort of paraphrase what you're describing with the Volcker rule, it strikes me that what you're saying is that there is one side of a bank which is virtuous by dint of the fact that it equally balances the interests of the shareholders, the staff, and the customer. And there is another side of the bank which is non-virtuous, where it only balances the interest of the shareholders and the staff, and the customer is completely excluded. And that's the sort of the core behind the Volcker rule.
I reject the word virtuous and non-virtuous. It's rather prejudicial.
No.
I mean, the one that has, I think, historically important public function. It's hard to see an economy working without commercial banks doing their essential function. It's not hard to see, for me anyway, to see the economy working without the amount of speculative activity and proprietary activity. And I'm not saying that's wrong. I just say let people do it who are not protected by the government and who can be permitted to fail because they don't have a essential function. But they can do all they want. Now, where it got mixed up, that's what the investment banks were doing. They were immensely profitable. But they got in trouble. Now they suddenly made themselves in the banks. Why did they make themselves in the banks? Because they want the government support. And actually, at that point, the government wanted to support them. The only way they could support them was by making them a bank. Now they don't want to give up their banking license because it's dollar and cents. They can't finance themselves. They're not confident they can finance themselves economically unless they're a bank.
I'm very interested by your whole idea of the cross-contamination of the institution, the banking institution, from the proprietary traders who have no interest in the outcomes of the customers of the bank, compared with the other people, the rest of the bank, who should have a vested interest, or do have vested interest in the outcomes of the customers. And I look back to the deregulation of the city in 1986,
what?
the deregulation of the City of London in 1986, when you were chairman. And at the time, the London Stock Exchange had two very, very clear functions. One was that if you were prepared to, if you took positions on your balance sheet, you were a market maker, you were never allowed to talk to a customer, and if you, or an outside investor, and if you were a broker who only talked to customers, you were never allowed to take a position on your balance sheet. And that, to me, really epitomised putting the customer at the core of the stock exchange by having that rule. Do you think we lost something quite special when we deregulated the system?
Well, you were faced, as you were in the United States, and you had all these mixed functions in the banks, by a whole technological revolution that made it much easier for different types of institutions to deal with each other, and made it easy for the traditional institutions to engage in these exotic activities. And you had at the same time, I think this is quite fundamental, at the same time you had a philosophical approach that said markets can take care of themselves. And we have a whole blossoming of theorizing about the efficiency of markets, the foresight of market participants, rational expectations, and things were going well for a while. So the whole implication was leave it alone. The market can take care of itself, and they'll have excesses from time to time, but they'll control it themselves because it's in their interest to control it themselves. Now that viewpoint isn't very popular anymore, given what happened. At least it went overboard, and that viewpoint was not consistent, quite specifically with massive growth of the subprime mortgage market, where it obviously went well beyond any kind of self-remediating function until it went over the cliff, and then it all collapsed. So you had a whole philosophical development that affected regulators, it affected banks, it affected politicians. It was a different climate. Can we go back to where we were 30 years ago by snapping our fingers and passing a law? No. But I think we can do things around the edge Well, it's more than around the edge. When you deal either Vickery or Volcker, it's more than around the edge. But it's not the whole thing. Let me say here, I get a little irritated when people say, what are you worried about proprietary trading? That didn't cause all the bankruptcies or failures. It certainly contributed to some of them, as I say, but that's not the point. It's the cultural damage that it does. And where's the corresponding or the offsetting public benefit? There is a public benefit in having reasonably active markets. Good, a lot of people are willing to do that. That's what the investment banks are doing all the time. That's what a lot of hedge funds are doing. They're not publicly supported. Hedge funds are largely financed by partners. Limited partners, they may not have much to say, but it's their money that's at stake. They're not by and large, they are debt financed too these days, but the heart of their financing is not whether they have a capital ratio of 3% or 10%. You know, it'd be 50%, 75%, or 40%. So that's different. And let them rise or fall on their own.
The Bishop of Durham spoke a bit earlier about pushing the toothpaste back into the tube in terms of standards. Do you think part of the answer could be to introduce more professional standards within?
Do what?
To introduce professional standards within the banking industry.
Yeah, well, it's not just in the banking industry. Better extend it to the legal profession too. I don't want to hurt any feelings here, but we have a real problem. Look at, it's getting more attention. What about auditors?
As far as I know, there aren't any on
banking
So
commission, so you're safe.
Anybody here
Unlike
can't
United
offend
States,
me?
where they'd all be lawyers.
I don't want some profession to go away with feeling I didn't offend them.